How should you invest your money in retirement? You've worked hard, you've saved diligently, and now you're retired or close to it. But what do you do? Do you move everything into bonds? Stay aggressive with stocks? Do you try to time the market? This is one of the biggest questions retirees face, and the wrong approach can create unnecessary stress or even jeopardize your income. So in this video, I'll walk you through how to think about investing in retirement, how to build a portfolio that balances growth and security, and how to avoid the biggest mistakes that can keep people up at night. I'm Cary, financial advisor and co-founder of Green Era Financial, and I help people close to or in retirement to get the most out of life with their money. And today, I'm going to help you understand how to invest with clarity and confidence. No guesswork, no gimmicks, just a plan that actually fits retirement. Let's start here. Retirement is different. When you're working, volatility is annoying, but you're still earning a paycheck. In retirement, your portfolio becomes your paycheck, and that's a big psychological and practical shift. The pressure to protect what you've built becomes real. Every dip in the market feels personal, and if you need to take withdrawals during these dips, it can lock in losses permanently, which is something called sequence of returns risk. When poor market returns in early retirement coincide with withdrawals, and it can do real damage to your long-term success. This means your mindset needs to shift. You're no longer just focused on growing your wealth, you're focused on maintaining it, protecting income, and preserving flexibility. But that doesn't mean you go into full defense mode. You still need growth to outpace inflation over what could be a 20 or 30-year retirement. Every retiree's portfolio has three core jobs. First, it needs to provide income consistently. Whether that's from dividends, interest, or selling investments in a planned and sustainable way, your portfolio must be able to generate the cash you need to support your lifestyle. Second, it needs to fight inflation. The cost of living doesn't stop rising just because you stop working. Healthcare, travel, housing, they all get more expensive. And if your money isn't growing, it's shrinking in real terms. So your portfolio needs a growth component to keep your purchasing power intact. Third, it needs to manage volatility. This is less about eliminating risk, which isn't really possible, and more about creating a smoother ride so that market swings don't throw off your entire plan. Diversification, proper asset allocation, and having a system for withdrawals all help here. A great portfolio balances these three jobs. It doesn't over-prioritize one at the expense of the others. It's not all about chasing growth. It's not all about playing it safe. It's about creating something that gives you freedom and peace of mind. Now let's talk about the most common mistakes retirees make, the ones that lead to stress and sleepless nights. The first is going all in on cash or CDs. On the surface, it feels smart. You eliminate market risk, but the hidden cost is inflation. If you're only earning 2% and inflation is running at 3 or 4%, you're going backwards. And over 20 years, that's a massive loss in purchasing power. The second mistake is staying too aggressive. I've seen people in retirement still holding 90 or 100% in equities. And that kind of allocation might have made sense when you were 45, not when you're withdrawing from your portfolio every year. A big loss early on can derail your entire retirement. The third mistake is chasing yield. This happens when people seek out high dividend stocks or riskier bonds that promise big payouts. The problem is, with higher income often comes higher risk. Some of those high dividend stocks aren't financially healthy companies. Some of those bonds are junk rated for a reason. And the fourth mistake, not having a plan for withdrawals. Just selling investments randomly or pulling from accounts out of convenience. That's how you end up with tax headaches and unbalanced portfolios. You need a strategy for where the income comes from, in what order, and why. One of the most helpful and intuitive strategies I use with clients is the bucket strategy. It's simple, practical, and designed to reduce stress. You divide your savings into 3 buckets based on when you'll need the money. Bucket 1 is your short-term bucket. This covers your needs for the next 1 to 2 years. It's usually cash, CDs, maybe a high-yield savings account. This is your income buffer, money you can access quickly without worrying about what the market is doing. Bucket number 2 is your midterm bucket. This holds money you'll need in the next 3 to 10 years. It's typically invested in bonds, conservative balanced funds, or dividend-paying stocks. And the goal here is income generation and capital preservation. And bucket number 3 is your long-term growth bucket. This is money you won't need for at least 10 years. This bucket is for stocks, equity funds, and growth-oriented investments. Yes, it's more volatile, but because you don't need this money for a while, you can let it recover from any market dips. Now, the way this works is as you spend from bucket number 1, you refill it from bucket number 2. And when markets are up, you take profits from bucket 3 and move them into bucket 2. This creates a natural, rules-based system for generating income and managing risk, and it helps you avoid emotional decisions. So how do you decide on the right mix of stocks and bonds? Well, there's no perfect formula, but most retirees fall somewhere between 40% and 60% in equities, with the rest in bonds and cash. The right number depends on your risk tolerance, your income needs, and your time horizon. Someone with a strong pension or other guaranteed income might be able to take more risk. Someone who's relying entirely on their portfolio may want a more conservative mix. What matters more than the specific numbers is that you have a strategy and that you review it regularly. Rebalancing your allocation once or twice a year helps keep things aligned and prevents your risk profile from drifting too far off course. Also, consider the tax characteristics of different accounts. You might hold growth-oriented assets in taxable accounts for long-term capital gains treatment and income-generating assets in IRAs. Your Roth might be the place for your most aggressive assets because the growth is tax-free, for example. Now, when it comes to what to actually invest in, most retirees use mutual funds, ETFs, stocks, bonds, and sometimes even annuities. Index funds are low-cost, diversified, and easy to understand. That makes them a great building block for most portfolios. Actively managed funds can make sense too, especially in fixed income where interest rate risk and credit selection matter. But make sure the fees are reasonable and the manager's approach aligns with your goals. ETFs offer tax efficiency and low costs, especially in taxable accounts. They can be a great option for building out your asset allocation. Annuities are more polarizing, but in the right circumstances, like when you want guaranteed lifetime income, they can make sense. Just be cautious. Some are very high fee, complex products that don't deliver the value they promise. So if you're considering one, make sure it fits into your broader plan and isn't being pushed on you by some life insurance agent just for the commission. Also, holding individual stocks is fine as well, assuming they are part of a cohesive and well thought out portfolio that strives for diversification and the proper risk parameters for you. Too often I see people who have a bunch of random stocks they've invested in without any kind of plan or portfolio concept at play. I call this the shotgun portfolio, and it's not a good thing. Just because you heard from a friend the stock is a good bet doesn't mean it has a place in your portfolio, and holding a bunch of random stocks can hinder growth more than help it. Finally, perspective matters more than performance. The best portfolio in the world won't help if you panic every time the market drops by 5%. That's why a strategy like the bucket plan, cash reserves, and understanding your actual income needs are so important. They give you breathing room, space to let the market do what it does without having to react emotionally. Investing in retirement isn't about chasing the highest return. It's about creating a consistent, reliable income stream that lets you enjoy life without worrying about what the Dow or the S&P 500 did this morning. So, if you want help building an investment strategy that's built for retirement, not just accumulation, feel free to visit us at greenerafinancial.com or reach out to me anytime. I'm always happy to help if I can. Thanks for watching, and I'll see you next time.